Experiencing Bitcoin's volatility can be absolutely brutal. It is very common for Bitcoin to suffer from 15% to 50% price corrections during bull markets and over 70% price drops at the end of bull markets, which is why most people are not comfortable with buying and holding Bitcoin. But what if I told you there's a strategy that not only handles Bitcoin's volatility, but helps you outperform most traditional assets? Hey guys, welcome to the Bitcoin Experience. In this video, I want to show you what I believe to be the best way to save in Bitcoin while keeping your emotions in check, regardless of how volatile the market gets. Bitcoin's volatility scares off a lot of potential investors and savers, but there is a strategy that turns these wild price swings into an advantage. It is simple, effective, and has a proven track record of outperforming the vast majority of traditional investments. Once I show it to you, you'll be ready to start saving and investing in Bitcoin with confidence. Now, if you get value from this video and you find it useful, it would help me a lot if you gave it a like, subscribe to the channel, or leave a comment down below. And with that said, let's get right into it. Bitcoin's volatility can be very hard to handle. Despite being an incredible asset, its volatility is not for those who shy away from risk. Corrections of 15%, 30%, or even 50% are not uncommon. If you've been in Bitcoin long enough, you've probably experienced weeks when the price plummets by double digits. I know I have over the last 4 years. Now imagine you invested a large sum of money just before one of these corrections. Suddenly, your portfolio looks like it's been cut in half. Again, something that I've personally experienced over the last 4 years in Bitcoin. That kind of loss isn't just financial, it is emotional as well. For most people, the fear of losing even more can lead to panic selling and locking in those losses. But it's not just the corrections that hurt, it's our reaction to them.
I am never going to financially recover from this.
This is where the DCA strategy comes in as a lifesaver. DCA stands for dollar cost averaging. So instead of buying all at once, you spread your purchases over time. With Bitcoin, these purchases can be set to automatically buy for you hourly, daily, weekly, or monthly. For example, let's say that you have $3,000 to invest in Bitcoin. Rather than putting it all in at once, you divide it into smaller chunks like $250 per week for 12 weeks. By doing this, you avoid going all in at what could potentially be a peak price. And when the market dips, you actually benefit by buying more Bitcoin for the same amount of dollars. Over time, your average cost will smooth out the highs and the lows. The beauty of a DCA strategy is that it removes emotion from investing and makes it much easier for you to stay consistent. Especially if you use an auto DCA setup where you schedule recurring buys and all you have to do is just top up your account with dollars, euros, or whatever fiat currency you are using to buy Bitcoin with. And this is a great moment to also mention that you should withdraw your Bitcoin to your own cold storage wallet as often as possible. Because unless it's in your self-custody, it's not your Bitcoin. It's just a promise from the exchange. Those of you who had Bitcoin on FTX, Celsius, BlockFi, or all these other exchanges that blew up over the last 3 years know exactly what I'm talking about. Because not your keys, not your coins. But going back to the DCA strategy, it ensures that you no longer obsessively check prices or worry about market timing. You simply stick to your plan no matter what the market's doing. Now let's compare this to lump sum investing. When you invest a large amount all at once, every price correction feels like a personal attack on your savings. It's really hard to stay calm when you see the value of your portfolio drop by 30% or more in just a matter of days or weeks. I've been through that myself, but I've handled it well just because I had strong conviction. Without that, it can be extremely difficult to withstand such corrections, especially the ones that happen at the end of bull markets, which are typically over 70%. Though it seems that these corrections are getting less brutal with every Bitcoin cycle. But with DCA, it's a completely different story. Each time the price drops, you see it as an opportunity to buy more Bitcoin at a discount. This change in mindset makes it so much easier to stay committed to your long-term savings plan. In my previous video, which I'll link in the description below, I broke down how a DCA strategy works even in worst case scenarios. Imagine starting a DCA strategy at a local all-time high followed by a 70% or more price correction. As long as you stick to that DCA strategy for at least 4 years, history shows that you will most probably come out ahead. And lump sum investing also yields positive returns over a 4-year investing period, but the psychological toll of dealing with the insane volatility is far greater. Not everyone is mentally prepared to deal with it. DCA, however, smooths out the ride. Now, here's the kicker. Saving in Bitcoin with a DCA strategy doesn't just protect you from volatility, it also helps you outperform traditional investments. Over the last 10 years, Bitcoin has consistently delivered much better returns than the stock market and gold. In fact, from the end of November 2014 to the end of November 2024, Bitcoin has surged over 25,000%, delivering an annualized return of around 78%. Now compare that to the Nasdaq, which returned a total of 382% or 14.2% annualized, the S&P 500, which returned a total of 234% or 8.9% annualized, the Dow Jones, which returned a total of 152% or 5.1% annualized, and gold, which returned a total of 127% or 4.2% annualized. As you can see, Bitcoin's performance is in a league of its own because it's been outperforming traditional assets by a huge margin. But if you think 10 years is too long, let's look at how Bitcoin performed against the exact same assets over a shorter time period. This shorter time frame is 4 years, which is the minimum amount of time that you should expect to save in or hold Bitcoin for. If you don't think you can do it for 4 years, don't even bother doing it for 4 minutes. But let's look at how Bitcoin performed against the same TradFi assets over the last 4 years. So from the end of November 2020 to the end of November 2024. Over this time period, Bitcoin delivered a total return of 403%, which is around 53% annualized, while the Nasdaq delivered a total return of 67% or 14% annualized. The S&P 500 delivered a total return of 63% or 13.2% annualized. The Dow Jones delivered a total return of 48% or 10.4% annualized. And gold delivered a total return of 44% or 9.5% annualized. So as you can see, even over a 4-year period, Bitcoin completely outshines these major traditional assets. Okay, now let's put this into perspective with a more hands-on example. If you had started saving $100 per month every month over the last 4 years, so from the beginning of November 2020 to the beginning of November 2024, you would have saved a total of $4,900. And here's how your savings would have performed if you had saved in Bitcoin or in these other traditional investments. In Bitcoin, your savings would have grown by over 111%. In the Nasdaq, your savings would have grown by over 51%. In the S&P 500, your savings would have grown by almost 43%. In the Dow Jones, your savings would have actually been down by over 10%. And in gold, your savings would have been up by 37%. So when we look at saving in Bitcoin, even with a DCA strategy, we can see that it still outperforms saving with a DCA strategy in these other traditional investments. The results clearly show that Bitcoin, even with its insane volatility, still outperforms these traditional assets. The real magic of DCA lies in its simplicity. You don't need to be a market expert or try to predict Bitcoin's next move. Whether you DCA hourly, daily, weekly, or monthly, the key is consistency. Over time, your savings grow as you stack sats without worrying about market timing. Bitcoin rewards patience and low time preference. If you stick to your DCA plan and hold for the long term, the volatility becomes your friend, not your enemy. What's more, DCA helps you avoid emotional decision making. Instead of panicking during massive price drops or FOMOing in during massive price surges, you stay the course and focus on the long-term picture. This psychological aspect is crucial when it comes to investing in an asset that is as volatile as Bitcoin is. Now, you might not be aware, but there are exchanges that allow you to buy as little as 1 penny's worth of Bitcoin at a time, and you can even automate this to buy for you every single hour. No other asset class offers this level of accessibility and flexibility. And the cool part is, whether you're saving $1 or $1,000 at a time, the percentage growth of your purchasing power is exactly the same. That's what makes Bitcoin such a revolutionary savings tool. And being able to automate your Bitcoin DCA strategy, no matter how much you're saving at a time, makes it so simple that you don't even need to think about it. It truly is a set it and forget it strategy. And as history has shown, if you give Bitcoin enough time, the volatility will smooth out and you'll see the purchasing power of your savings grow. If you would like me to make a video about what exchanges allow you to set up an automatic DCA for Bitcoin, let me know in the comments. And that is it for this video, guys. Thank you so much for watching and sticking with me until the end. Don't forget to give this video a like if you got value from it, and consider subscribing for more valuable content. If you have any questions, feedback, or even criticism, please write them down below in the comment section and I'll make sure to get back to every single one of you. Until next time, guys, keep stacking, keep hodling, and remember that a Bitcoin DCA keeps poverty away.